Welcome to Iron Financial. This is the place where we forge stronger portfolios by stress testing the market's biggest stories. And today, we are going deep on a name everyone knows, but from an investment standpoint, very few actually understand. Krispy Kreme, ticker DNUT. We're going to cut right through the sugarcoating to find out if there is a solid financial structure under all that glaze, or if this company is just a high-leverage trap waiting to spring. I'm your lead analyst. Let's get into it. So picture this. It's February 26th. You're watching the pre-market, and all of a sudden, Krispy Kreme stock just goes vertical. We're talking a massive sugar rush on Wall Street. The stock absolutely explodes, jumping over 21% before the opening bell even rings. Now look, this wasn't some random meme stock nonsense. This was a direct, almost violent reaction to their fourth quarter earnings report for fiscal year 2025. You saw the headlines, the market was absolutely euphoric, and for a moment, it really looked like the donut giant was finally building on some solid ground. A move that big, that fast, forces us to get in there and ask, what in the world did the market see that it liked so much?
Whoa, hold on a minute. A 21% pop is fantastic if you're day trading, but we're not. We're here to forge long-term portfolios. So the real question has to be, is this recovery built on a foundation of solid steel, or is it just empty calories? I'm the market skeptic, and my job is to cut through the hype. Is this a genuine, durable turnaround, or is the market just getting high on a single good quarter while totally ignoring the serious, deep cracks in the company's financial armor? We gotta ask, is it real or is it hype?
That is the question, and that's exactly what we're here to figure out. We are going to hammer this out piece by piece. First, we'll dive into the sugar rush. We're going to dissect those Q4 numbers that sparked all this optimism. Then we will lay out the turnaround blueprint that management has put on the table. But after that, and this is absolutely crucial, we're going deep into the debt overhang because, let's be clear, that is the single biggest risk factor here. And finally, we'll weigh all the evidence and deliver the iron verdict. By the end of this, we're going to have a forged, clear perspective. All right, let's start with the bull case. Section 1, the sugar rush. What did Krispy Kreme actually report that got investors so fired up? This is where we drill down past the headlines, get into the weeds of the fourth quarter 2025 numbers, and really see what's powering this massive move. Okay, so what's really fascinating here is the sheer scale of the earnings beat. Just look at that EPS line. The street, the analysts, they were expecting 3 cents per share. Krispy Kreme came in and delivered 9 cents. That is a 200% positive surprise. I mean, that's not just a beat, that's an absolute blowout. And yeah, the revenue beat was pretty small, just a little over the top, but that massive bottom line outperformance screams that something has fundamentally shifted inside their operations. It's a huge signal that they are finally getting costs under control and morphing into a much more profitable, much more efficient machine. That's the kind of number that gets the big institutional money off the sidelines and into the game. And this wasn't just some accounting magic trick either. This earnings beat was built on a really solid foundation of real, tangible, operational improvements. Now, before we go on, let's talk about this term you see everywhere, adjusted EBITDA. What is it? Well, companies love to use it. It's their way of trying to show you their core operating performance. It stands for earnings before interest, taxes, depreciation, and amortization, and then they throw in some extra adjustments of their own. The idea is to show you how profitable the main business is. And in this case, it was up 21% year over year to $55.6 million. But even more important than that, they actually generated positive cash. Free cash flow, the cash left over after running the business and making investments, was a positive $27.9 million. This tells us the company isn't just profitable on a spreadsheet, it's generating real hard cash. And cash is the lifeblood of any business, especially one that's trying to pull off a turnaround. So you have to understand, these numbers didn't just fall out of the sky. They are the direct result of a new, deliberate strategy. So let's move to our next section and see how this all connects. The turnaround blueprint. We need to really understand the plan management is executing because the long-term investment case, all of it, hinges entirely on whether this blueprint is structurally sound or not.
And this is the message coming straight from the top. The new CEO, Josh Charlesworth, is essentially getting on the microphone and telling investors, see, the plan is working. He's pointing directly to those profitability improvements and the strategic store optimizations, things like shutting down underperforming locations that were bleeding cash, as concrete proof points. This is management stepping up, taking ownership, and telling the market in no uncertain terms that they have a firm grip on the controls and a clear path forward.
And this slide right here, this lays out the blueprint itself. Management has broken it down into 4 very clear, very logical pillars. Number 1, refranchising. They are actively selling off company-owned international markets and restructuring a major joint venture in the Western U.S. Number 2, driving return on invested capital. In simple terms, getting more bang for their buck by spending less on heavy capital projects. Number 3, expanding margins. This means finding efficiencies everywhere, like outsourcing their U.S. logistics. And number 4, driving sustainable growth in their core U.S. market by focusing on profitability, not just growth for the sake of growth. It's a disciplined, back-to-basics blueprint for building a stronger company.
Now, that first pillar, refranchising, it is the absolute cornerstone of this entire strategy. The goal here is a massive structural shift in how they do business. Think about it. In 2025, a whopping 3/4 of their sales came from locations the company owned and operated itself. That is a heavy, capital-intensive model that acts like an anchor on the balance sheet. By 2027, they want to get that number all the way down to nearly 50%. This creates what's known as a capital-light model. It literally takes the immense operational and financial burdens off of Krispy Kreme's own books and shifts them over to their franchisees. They'll be the ones spending the money to build out new stores. And what does that do for Krispy Kreme? It frees up a ton of cash to do one critical thing: pay down their mountain of debt.
Okay, that all sounds great on paper. The blueprint is logical, the Q4 numbers definitely look strong, but this is iron financial. We don't just read the highlight reel. Now it's time to stress test this company. It's time to talk about the elephant in the room, the debt overhang. We have to look past the adjusted numbers and all the forward-looking promises and stare directly at the serious structural weaknesses that could bring this entire turnaround crashing down around them.
Let's start with this number. Just forget about the 9 cents of adjusted profit in the fourth quarter for a second. For the entire fiscal year of 2025, according to official accounting rules, Krispy Kreme posted a GAAP net loss of over $500 million, $523.8 million. That is a staggering, mind-boggling loss. So while the market was popping champagne over one good quarter, the full-year picture shows a company that was bleeding an enormous amount of money. This isn't just a small crack in the armor, this is a gaping hole in the side of the ship.
So, where did this $500 million black hole come from? Let's break it down. As this chart shows, the single biggest driver, by a long shot, was a massive $432 million charge for what's called goodwill and asset impairments. You know what that is in plain English? It means the company is officially admitting that things it bought in the past, like other companies or brands, are no longer worth the high price they paid for them. It's a massive write-down. It's a public acknowledgement of a past strategic mistake. On top of that, their actual full-year net revenue fell by nearly $143 million, and they paid out almost $66 million in interest expense alone. This is the ugly reality behind the curtain.
And that interest expense, that leads us directly to the most dangerous number of all, the leverage. At the end of 2025, Krispy Kreme's net leverage ratio stood at a terrifying 6.7 times. That means their net debt was 6.7 times their full-year adjusted EBITDA. Just to give you some context, a healthy company is typically below 3 times. A ratio this high is a 5-alarm fire. It's an enormous weight on the company's back. If anything goes wrong with their turnaround plan, say a recession hits, or sales suddenly slow down, a debt load this large doesn't just hurt, it can be fatal. It gives them absolutely zero margin for error.
So here's the bottom line, the crucial point. There are two completely different, competing stories being told here. On the left, you have the analyst's view, focused on the forward momentum of that one strong quarter, shiny adjusted EBITDA, some positive free cash flow, and a stock that's on a sugar high. This is the story the market is betting on. But on the right, you have the skeptic's view, which is looking at the disastrous full year, a $500 million GAAP loss, nearly $1 billion in net debt, and a dangerously high leverage ratio. The market celebrated the story on the left. The risk, the trap that could wipe you out, is the story on the right. And what this all comes down to is the critical difference between GAAP and non-GAAP accounting. GAAP numbers, like that massive net loss, are the official, audited numbers that have to follow very strict rules. They include everything, the good, the bad, and the very ugly, like those asset impairments. Non-GAAP numbers, on the other hand, like adjusted EBITDA, are created by the company itself. They get to exclude certain items they consider one-time or non-operational. Now, while non-GAAP can be useful for seeing the core business performance, in a case like this, it's also conveniently hiding nearly $500 million in real losses. As an investor, you have to look at both, but you ignore the GAAP numbers at your own peril. Look, those are all critical points. The debt is undeniable, and that full-year GAAP loss is a very serious problem. You can't just ignore the past. But as investors, our job is to decide if we're betting on where the company has been or where we think it's going. The market is always forward-looking. So in this final section, the iron verdict, we have to weigh all the evidence. Does the turnaround plan have enough structural integrity to overcome the immense weight of that debt?
This slide here, this shows management's contract with investors for 2026. This is what they are promising to deliver. They're guiding for 2 to 4% sales growth. Nothing spectacular, but it's modest and stable. More importantly, look at the other numbers. They are slashing capital expenditures, their CapEx, by almost half. They are committing to generating positive free cash flow for the entire year. And here's the big one. They are targeting a net leverage ratio at or below 5.5 times. This is a direct promise to attack their single biggest weakness head-on.
And these aren't just empty promises floating out there. They have clear, tangible levers they are pulling to make this happen. First, that refranchising of their Japan market is expected to bring in about $65 million in cash in the first quarter alone. That's real money. Second, restructuring that U.S. joint venture is also going to improve their financial flexibility. And third, that massive cut to CapEx, combined with ongoing cost controls, is all designed to generate the cash flow they desperately need to pay down debt and hit that crucial 5.5x leverage target. These are concrete, actionable steps.
And that right there is the billion-dollar question, isn't it? The plan looks good on a PowerPoint slide, but let's be real, reducing leverage from 6.7x down to 5.5x is still just a start. That is still a very, very high level of debt. So are these moves, selling off Japan, cutting some spending, are they really enough to fix the fundamental problem? Or are they just patching a few holes when the entire foundation is at risk of cracking under the weight of nearly $1 billion of debt? This requires flawless execution. The market is not always forgiving. You are asking management to walk a tightrope with absolutely no safety net below.
Ultimately, what this whole thing comes down to is this. Nobody, and I mean nobody, questions the product. Krispy Kreme donuts are an iconic, globally recognized brand with incredibly strong consumer demand. That is their greatest asset, hands down. The problem has never been the donut. The problem has always been the balance sheet. So the entire investment thesis rests on one single thing. Do you believe that the current management team can actually execute this difficult financial deleveraging and build a truly resilient company? The product is strong, but the financial structure has been incredibly weak for a long time.
So that is the final question we're going to leave you with today. The turnaround blueprint is on the table. It's clear for everyone to see. The market has obviously bought into the potential. You saw it in that massive stock surge. But the risks are just as massive. The debt is real, and the margin for error is razor thin. So is management strong enough to do the heavy lifting required to rebuild this company from the ground up? Or will the immense weight of the debt eventually cause the whole structure to collapse? That's the question you have to answer before putting your capital to work. Thanks for joining us here at Iron Financial. We'll see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.